Hello and welcome to ET Market Smart Talk. Well, my name is Shretaj Anand, and as we head into 2026, investors are navigating a very different market landscape. Equity volatility remain elevated, bond yields are at multi-year highs, and global uncertainties continue to influence capital flows. Now, with budget 26 on the corner, fixed income markets are firmly in focus. Now, to discuss what investors should watch out for and how asset allocation strategies may need to rethink. I'm joined by Puneet Pal, who's head of fixed income at PGIM India Mutual Fund. Puneet, thank you for joining us.
Thank you, Shidich. Glad to be here once again.
Thank you so much for taking the time out. And Puneet, as Budget 26 approaches amid elevated bond yields and heavy government borrowing, what are the key signals fixed income investors should watch out for in the budget?
I think the fixed income markets are looking at budget from a fiscal consolidation point of view,
Mhm.
but they don't seem to be overly worried about the central's fiscal deficit because I think the government has been pretty successful in managing their fiscal glide path, what they had
Right.
enumerated some time back. So
Sure.
I think now it's very clear that the government is going to target debt to GDP as the barometer for measuring fiscal performance, and
Mm.
it's targeted at 50% by 31st of March 2031. So I think
Okay.
from that perspective, the bond markets are pretty comfortable with that glide path.
Mm.
The real worry for the bond markets of late has been the state's fiscal deficit or the borrowings by the state governments, which
Okay.
have been rising. In fact, if you look at
Mm.
the increase, it's almost more than 17%, almost 18% increase in the state's borrowing on a Y-on-Y basis.
Okay.
So I think that's where the worry is for the bond markets, and we'll see how that pans out in the new year. But from a central's perspective, I think markets are pretty comfortable with the glide path on targeting of
Mm.
50% debt to GDP.
Absolutely. And how could change in fiscal deficit targets and borrowing plans in budget 26 influence bond yields and overall demand for fixed income assets?
I mean, they are pretty important, very crucial. I mean, we have seen this in this year, FY26, that
Mm.
we had the rate cuts. We have a pretty strong downward movement in the bond yields in the first half of the year till June. But
Okay.
thereafter, as the supply concerns, especially from state governments, increased, we saw the yields also going up.
Mm. Mm.
So it plays a major part. Obviously, it influences the demand supply, and right now we are looking at a scenario where the gross borrowing numbers of the central and the state government combined could be in the vicinity of 28 lakh crores or even more.
Okay.
So that does influence bond yields, and I think markets will be looking forward to some kind of fiscal prudence, especially from state governments, as I mentioned earlier. I think from a
Mm.
central perspective, bond markets are pretty okay with that. Uh, so from a, I think overall fiscal perspective, they will be looking at central and state both combined and not only focused
Mm.
solely on the central government.
Absolutely. And do you expect budget 26 to prioritize bond market liquidity and depth, especially to support growing retail participation?
I'll not say that they will prioritize that because I think right now the government's focus or priority will be on ensuring growth,
Mm.
especially nominal GDP growth, given the backdrop of the US tariffs that I mean we have been facing over the last since August end. So I think the priority will be to ensure that the growth doesn't get the growth trajectory doesn't get disrupted because of these events, and we have already seen the government
Mm.
taking steps to elevate that concern by way of GST rate cuts,
Mm.
and there can be more in the offering in the budget. So I think in terms of prioritizing, they will probably prioritize growth. I think that is a clear objective of the government. And on the bond market side, I think RBI has, I mean, they have launched a retail direct platform some time back, and I think in terms of ensuring adequate depth and liquidity, I think RBI has, I mean, the RBI governor has enumerated in his various speeches at various
Mm.
platforms that they will ensure adequate liquidity for the markets or for the banking system as such, so
Mm.
as not to hurt the credit growth in the economy, which is, I mean, pretty strong right now. I mean, it's outpacing the deposit growth. So from that perspective, the bond markets get indirectly benefited because RBI does almost to inject liquidity. But
Mm.
from a retail participation, I think we don't expect any special measures as of now. Probably they'll build upon the platforms which RBI has launched, the retail direct platform earlier. So I
Sure.
think they'll just build upon that.
All right. And what is driving the shift from traditional bank FDs to regulated bond and fixed income alternatives among retail investors, Puneet?
Well, I think obviously, I mean, you have seen now some bond platforms who are offering quite attractive returns.
Sure.
Though the risk has to be taken into account. Obviously, the
Mm.
risk is much higher as compared to a bank FD. And
Mm.
alternate platforms are also being used by, I will say, not retail, but maybe ultra HNIs or family offices to
Mm.
invest money over there. But again, as I mean, as the game I'm saying goes that risk is directly proportional to the, I mean, or returns are directly proportional to the risk that you take. So one
Yes.
has to
Yes.
take into account the risk while investing, and
Mm.
I think it's just that the returns are attractive at a time when the FD rates probably had come down in line with the
Mm.
rate cut or the easy bond stance of RBI. So
Yes.
people are looking at alternatives to increase their returns on investments, especially on the fixed income space. So,
Mm.
I mean, bonds which are slightly lower rated, offering better yields, and
Mm.
alternative platforms offering better yields. People have shifted some of their investments over there, but one has to take into account the risk while looking at the returns. I'll just say that.
Ab- Absolutely. And for first-time bond investors in 26, what are the key risks and misconceptions they should be aware of, especially in a volatile rate environment? Oh, okay. Puneet, did you get what I'm trying to ask you?
I
Were
think
you
it
able
got
to get
paused.
that? Okay. For the first-time bond investors,
Yeah,
can you
I
hear
think we
me?
lost.
Puneet, can you hear me now? Okay. Can you hear me now? Can you hear me
No,
now?
I think we lost you in between.
Okay, okay, no worries. So I was just trying to understand for the first-time bond investors in 26, what are the key
No,
risks and misconceptions they should be aware of? What are the key risks that investors should be aware of
Guidance to
in
investors
in the year 26?
in 2025. What is your advice to investors?
Yep, Puneet, you can
I
if
can't.
you're
Whether
able
they
to
can
hear
hear us
me.
or not.
Yes, of course we can. Okay,
Okay, really?
okay. I guess we're
I
having
think we
some.
lost. We are
Okay,
not able to. No,
sure.
I'm not able to hear.
Okay. Can you hear me now? Can you hear me? Okay, no worries. No worries. I will just do we will just quickly do
Better, I
one
think.
more test with you.
It's not coming.
Okay. Uh, okay, just give me a minute. Sure, no worries. Uh, mm, Puneet, I'll just quickly do one more check with you if you're able to hear me. Check audio check 1 2 3. Puneet, if you can hear me, I can we can repeat this once again. Check audio check. Can you hear me now, Puneet? Check audio check.
Well, timing is on, but
Hmm.
Puneet, can you hear me?
Yeah, yeah, I can hear you now.
Okay, great. Sorry about this.
In between, we just
Uh,
lost.
no worries. I'll just quickly, quickly try my second last question. In fact, so
Sure.
for the first time bond investors in 26, what are the key risk and misconceptions they should be aware of, especially, in a volatile rate environment like this?
Yeah, very good question, Kshitij. So I think for the first time investors, the key is to be risk aware. I mean, every investment, whether it's fixed income or anything else, they should be aware of the risk that comes along with the investment. So I think for first time
Okay.
investors, the key should be to first analyze what their goals are, what is the objective that they're trying to solve while investing, whether it's a short term
Mm,
goal or a long term goal, and to align their risk appetite according to the investment's risk itself. And secondly is duration matching. What we in simple terms probably say is that align your objectives timeline with the duration of the investment. So a
okay.
person who is just looking to get let us say just parking money for safety before he probably finds a better alternative investment, he should just park the money. He's not sure about his investment horizon in a liquid fund or in a money market fund,
Mm,
and not in a gilt fund or a long duration fund. Anybody who's looking for his retirement corpus, which is maybe probably 5 years away or 10 years away, should probably look at medium term funds or long duration funds. So this
Mm,
kind of duration alignment, along with the risk that they are taking, that should be
mm,
the cornerstone of first time investor.
mm.
And start in a smaller way. I will just say that first test the waters and then increase your investments over a period of time.
All right. Very quickly, what about the asset allocation? Somebody is thinking about investing for the first time.
Again, I think again starts with risk. So it has to start with risk and the objectives that you have in mind while investing.
Sure.
So I will say that currently, from a fixed income perspective, the longer duration yields do look attractive,
Mm,
but there are near-term headwinds in terms of pressures from higher supply, as we discussed earlier.
right.
From global macros, bond
Mm,
yields globally are elevated in spite of rate cuts by central banks. There is a fiscal challenge that developed economies are facing, a debt challenge developed economies are facing.
mm,
Indian macros are better, but we have seen some volatility in the external front, especially in IRA. So overall, I'll say that keeping in mind the duration, the risk, you can probably have 40% allocation to fixed income going ahead in this year,
okay.
because the yields are an attractive level, both from a
Mm,
nominal perspective as well as from a real perspective. So if you look at
real
inflation,
perspective.
any investment has to look at what kind of return it achieves beyond inflation or over and above inflation. So from that
Mm,
perspective, if you look at the 10-year state government bonds or the 20, 30-year central government bonds trading closer to
mm,
740, 7.5, they are giving a very good real return over inflation,
right.
which is expected to be around 4.5 for FY27. So if you're expecting
Right.
inflation to be 4.5 for the
Mm,
next 1 year, and with inflation targeting working quite well for India, I
right.
think 7% plus closer to 7.5 makes a decent investment. Only thing is that the investor has to take into account the risk as well as the investment horizon. So invest in long-term bond funds only when your investment goals are far off. You can wait patiently for that. For any short-term needs, look at the money market
Mm.
funds. But overall, we'll expect or we'll say that an investor can look at 40% allocation to fixed income.
All right. That's the word coming. 40% allocation can be done in 26 towards fixed income. Puneet, thank you for sharing your insight on how fixed income fits into the 2026 investment playbook. Thank you so much for taking the time on.
Thank you. Thank you, Shade. It's a pleasure. Thank you.
Thanks so much.
Thanks.